Today's strategy is going to be about the only technical day trading strategy that you will ever need. So it doesn't matter if you're a banker, hedge fund, retail trader, everyone uses a sense of technicals. So everyone always talks about what strategy do you use. What a strategy actually is, it's a bunch of technicals combined into one, forming a trading strategy. And obviously if you name that strategy, then you will have your own strategy. So today's video is going to be about going through everything from candlesticks to support resistance to fib to trend lines and showing you guys how to compile everything and how to figure out what technical will work better for you to obviously implement into your strategy. Okay, so candlesticks. Candlesticks is literally what tells us if the sellers or buyers in the market. Okay, so what we need to understand is how candlesticks work. Okay, so you have a time frame. If we're in the 6H time frame, that means every candle represents a 6 hour. Okay, obviously the lower the time frame, the more candlesticks there is. So if we look at this block, okay, so that is from Friday. So this is about 3 days worth of data. And if we go to the 15-minute, it's a whole different situation. So the lower time frame, the more complex it obviously starts getting, which is something which is very important to understand. Okay. So how a candlestick works is, for example, we have this current candle. Okay. This current candle opened where the previous one closed. Then we started pushing down. At that point, it was a red candle or a blue candle pushing down. Then we formed a low point. Then it went back up above the open price, and then it became black or green. So at the moment, we are pushing to the top side. Okay. So if this candle now closes there, the next candle will open there. But most probably this candle will hit a certain point and then start pulling back, forming a wick at the top as well. So the only thing that's important and that matters when it gets to candlesticks is two things. Don't care about the color or anything in that sense. It's about the wick, okay, and about the body. Okay, if we look at this candle, we can clearly see price came down, closed there, rejected. Okay. Then all of a sudden, a little bit of a body in the middle, big tail at the top, big tail at the bottom. That is usually a form of a morning star formation. Then we closed here, pushing lower, forming a low point, putting all the way up, then forming what is called a bullish engulfing candle. Okay. That bullish engulfing candle is another big indication of buying. So what you can actually do is after that bullish engulfing candle, look left, and then you can actually start buying after that candle as well. You can jump in once you see that rejection there. I usually jump down to the 30-minute and I look for entry on the 30-minute time frame. But that's the in and out of obviously candlesticks and how they work. Okay, very important is also the higher the time frame, the more important the candlestick. So if we look at weeklies, okay, so a lot of people, for example, will see a sell over there. But what we should be seeing is a big bullish candle, big weekly bullish close, okay? So we did end up having a pullback, but what we should actually see is that we are about to continue to the top side, just by looking at the weekly candle close. Okay, So we can immediately see we are on our way going there. Okay, so same thing like this. If we obviously close with a big tail at the bottom, that's called a pin bar. So then we are obviously continuing to the top side. Last week, we also had a big bullish engulfing candle. So this week, the only thing we knew is that after that week, we're just waiting for a pullback, okay, into our buying block. And then we're looking for the continuation. We're not looking for sells. Okay, just the candlestick alone can tell us that we are looking for buys. And then the key thing is looking at the different candlesticks and implementing them and understanding them and using them for entries and for trend directions. I always say this, if we look at, this is obviously in a buying trend, okay? Market goes up, high, look at that lower high, okay? Rejection, 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 buy. Market forms a high, pulls back, then spinning bottoms, bullish engulfing candle, and a buy. Market pushes up, morning star candle, off formation, pin bar, buy. Market pushes up, morning star formation, hangman candle on the bottom of trend, buy. Market pushes up, comes all the way down, no rejection, drops down to this level, morning star formation, pin bar, and a buy. Okay, so every time the market drops down, there's rejection. And that's what I always tell you, you don't need to rush into the market. You do not need to rush in the market. You can wait for candlestick confirmation before either entering a position or exiting a position. Okay, so the trend. The trend is, for me, one of the most important things there is. Okay, if you are trading with the trend, you will end up with higher profitability in the long term. Okay, I educated an older gentleman about 6 years back, and the first thing he told me, he's been trading for about 22 years, but obviously he wanted to learn some new ways, especially with the new day and age education coming out. And he said to me, remember, the one thing that he knows is a trend is your friend. And since then, I've been stuck on that quote, and that is literally everything that I live by in a sense. Trend is your friend. Okay, so let's quickly show you guys how I identified the trend, and obviously what I did when I was a beginner as well. So when I was starting off, obviously I was struggling to understand, is this a high, low high, etc. So how the market actually works is it runs in cycles, okay? So this is an uptrend, okay? So uptrend forms part of a higher high point, a higher low point, a higher high point, a higher low point, and a higher high point. So that is an uptrend where we will see this. Okay, so that's when you usually see like in HL. Okay, HL. HL. Then you will have another HL and then high. So this is usually also the first indication of what's actually happening in the market. Okay, so within that trend, you're obviously going to have daily trends, 4-hour trends, etc., which we will get into. And then a downtrend is obviously seen as this. This is a downtrend. Okay, low, high, low, high, low, high. So that is seen as a downtrend. Okay. So now the next important thing to understand is in that weekly trend is going to be a daily trend. Okay. So sometimes, although this is just a pullback on the weekly trend, on the daily trend, it's going to look something like this. Okay. So on the weekly, it's a pullback, but on the daily, it is a selling trend, because now we're forming low lows, low high, low high. Okay, so on the weekly, it's up, but on the daily, it is down. So very important to understand that we do get a trend inside a trend. Okay. So you can be in the daily downtrend and selling, and then in the weekly, you can still be up. Okay. So now this gets to a point where for a lot of traders where it's confusing because it's like it's weekly is up, daily is down. Where do we actually go? Do we buy? Do we sell? What is our go-to for this specific market? So what I mostly do is I mark off. I used to use this path tool. Okay. So firstly, understanding what is seen as a high low or low high. Every time a market actually hits a point and moves into a direction, that will be seen as a high high or a high low. So you can also see it as the high points, okay, and the low points, okay. So if we look at that, now we do have that high point, market went all the way down, just kept going down until it reached that point. And then we have that point over there, that's also seen as a point, but then price went up. From there, it pulled to the downside, then it pulled down all the way there. So let's quickly mark off this trend. Okay, there was a high high, then a high low, and then a high high, and then we went all the way down. So obviously, close below that previous level. So just that close below will indicate now that we are in a selling trend. Okay, market then came up and formed a what? A lower high. So currently we are anticipating a sell-off to the downside on the weekly. Okay, so what I used to do is I used to take the path, then I'll actually go and draw it on. Okay, this is what I did every single Sunday. Okay, then I'll actually save that and say, okay, weekly. Weekly is selling. Also make it smaller if that is something that you would like to do. But then I'll write down weekly is selling. Okay, then I go to the daily. Daily, don't need to go back too much. So what I'll usually do is I'll just mark off the weekly high and the low. The reason I do this is for us to have a trend breakout. This is how it works. Okay, as we obviously have uptrend, we form higher highs and higher lows. So every time we form a higher low, it is seen as the point of interest that needs to be broken for a break of structure. So if the market comes down and hits that level, okay, and buys up, still in a buying trend. But if the market closes below that previous high low, then we'll come back, make a lower high, and we will start going into the selling trend. So that's always how it works, and that's why we always mark off the previous high low and low high. So as long as we are below this point, we are still in a selling trend. Okay, now we can also look at the daily. Okay, daily is going up. Okay, pull back, and then just there. Okay, so we had a, let me just quickly go a little bit back, guys. Okay, so we can see here we were in a buying trend. High, 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 low. High, 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 low, high, 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 low. See, we never broke through that point. We just made it equal, high, low, high, high. So then all of a sudden we're forming a double top, which is something we'll get in later on, but we're forming a equal low high. On what? On the weekly low high. So this is obviously our weekly low high point. Okay. So as long as we stay below that point, we are selling. So although most people anticipated another buy there because they're thinking of the daily trend, they forgot us hitting that point is now jumping into the weekly trend. Jumping into the weekly trend, and all of a sudden we are going for a selling market once again. So yes, we are going daily buys, but now we are going for weekly sells because the weekly sales are lining up with the daily. Okay, so now we can see, okay, there's a lower low. There was an equal, okay, an equal higher high. Then all of a sudden, when we break that point, we become a selling point. When we break previous, okay, so I'm just going to repeat that. Sorry, guys, we had something pop up. One of my own YouTube videos popping up on my screen. So that was the previous high low. Made a higher high. Then price went and made a high low there again. So then we move our high low block to that point. And as soon as we close below that, we know we're looking for a sell. So now we're just forming a lower high once again, and that's why we are anticipating for price to move to the downside. Okay, we can't say we're going for a new low yet. Now we can only say we're going to most probably match the weekly low. And if we don't break the weekly low, what will happen? Then we're equaling the weekly low, and that will then indicate for us to start with the daily buying trend again until we reach the weekly high. So we're basically trading between these two levels at the moment. And as long as we stay below that level, we are obviously anticipating a selling market. Okay, guys, then finally, obviously, once we have the daily trend, so now we know that we're selling. I'm just quickly, you guys will understand the reason for selling later on. We can see selling pressure there. We have our 61 fit. So we were looking for short positions on that level. So now we can actually drop down time frames. So there it pops into our point of interest. Okay, market comes down, forms a high low. So we can actually mark that level off. And once we break that level, we can look for position. So basically waiting for a shift of momentum or break of structure on the lower time frames. Okay, let's look at another example. Okay, market goes there, bumps into that weekly level that we just had in. As soon as we bump into that level, we come and we make a high low. Okay, then we just add that point, and once we break that, we look for a pullback and a sell-off to the downside. And you can actually see how we keep selling until you break above that lower high again. Then all of a sudden, you're a shorter time frame selling trend, buying trend. There we buy, okay? And then all of a sudden, we're breaking that bigger structure again, and then we're hitting sales again. So I will explain the pullbacks to you guys on the later stage as well. But it's so important to understand the different trend at first, and then from there start scaling down. So now, if we know, okay, well, long term, we're looking for a sell, then we can drop down to the 15-minute, the 30-minute, whichever time frame it is, and then all of a sudden you can start trading. So now we know, okay, well, we're only looking for sales, because that's what the bigger trend is saying. So we know there's a previous lower high point. So we're looking for two things now on the smaller time frame. Point number one is we're looking to break that higher low, then move back and sell. If we don't break that, then we're looking for a move higher and then a sell. Okay, because that was the previous higher low. So first identify the higher time frame and then move to the lower time frame and then scale in on the lower time frames. Okay, so the first technical we are going to be working on, we need to remember a trend is not a technical. A trend is something that we use and something that we need to understand when looking at trading. Okay, so the first technical we are going to be looking at is called support and resistance. Okay, so let me first explain to you guys the concept of support and resistance. Okay. The way I see support resistance is seen as a house, okay? Support is your floor, resistance is your roof, okay? So if price starts trending between these levels, okay, this is our support level, that is our resistance level. Support supports the market to go to the top side, resistance resisting the market to go to the downside, okay? Once resistance is broken, resistance becomes support, and then it forms a new resistance, and that's how it keeps trading. The history behind support resistance is over time, hedge funds, banks, everyone together starts buying from certain levels, okay? And that's the reason we can trade Forex, because there's previous buying levels. If we look at this level over here, that was 2005. Same thing happened in 2021. The market repeats itself because all we have to work with is market patterns forming over time. And obviously technicals of support resistance is the first technical. So later on, we're going to look at different technicals that will also influence price. And over time, those technicals will be used at the same levels, same prices, obviously, to trade again. So how do you identify a support resistance? Two things. You need two turning points. We need to remember we are working with a $1 billion industry, $1 billion a day industry. So if this market runs up and all of a sudden just goes the other way, something is selling this market from that point. I think we all understand and know that. This market is not going to turn around because someone with a $200 account decided I'm turning around this market now. Somebody and a few people with billions and billions of dollars need to push this market to the downside, indicating resistance, selling pressure, selling the market to the downside. Okay. So through that, support and resistance is formed. Okay, so there we can also see there is some support levels there. Just quickly clean this off. Then we have support level there. So we have multiple support levels lining up within the market. There's point one, there's another point. So this one, for example, will move a little bit higher. Okay, yes, we have a spike lower, but there we also have a turning point. And there we also have a turning point. So we're always looking at the point with the most turning points. Okay, the point with the most turning points is obviously the strongest support resistance. And the same thing with everything from candlesticks to trend. The higher the time frame, the stronger the support and resistance. Okay, so now that I explained to you guys that support becomes resistance and resistance becomes support, that's not actually a fact. Okay. It's just seen as the structure of if support's broken, support becomes resistance. If resistance is broken, that resistance becomes support. Okay? But in the end, the support and the resistance is a different thing. Okay? The way I see support resistance is I see it as hedge funds. Okay? Hedge funds trades from key levels in the market. So isn't support resistance a key level? That's exactly what it is. So let's quickly jump down to the daily. I usually don't do higher time frames. I usually just look at the daily time frame and then trade from there. Okay. So the one thing we need to understand is there's so many things happening in the Forex market. We have news, we have governments messing up things. So we need to focus on the art of the consistency. That's what I always keep saying. Look at the art of the consistency. Sorry guys, I'm just looking at something to the left. So now if we look, we take our support from the bottom, we move it up. All of a sudden we see, well, there's buying pressure there, there's buying pressure there. That's all we need. Okay. If this market buys from there, to where does it end up buying? Okay, somewhere in that range. If it buys from there, where does it buy? Somewhere in that range. Now we take it from the top. Okay, boom. And there we have selling level. We have the selling level. And we have a selling level. Okay, forget about that one spike. Because if we look at that one spike, this is where retail loses. Look at that big candle. Okay, that's a 1,800 point candle on a day. For USD, that's a lot. Okay, so if you understand your page, you will know that that is a fundamental. And if you actually go to 15 December 2022, you would see some fundamentals coming through. So once again, focus on the art of the consistency. Every time the market spikes through or does something weird, you'll usually see a big fundamental candle coming through. Okay, so now we have these key levels of support resistance. You get key support resistance, and then you get minor. Key is where price always turns around. So what you can also do is mark it off if this makes it easier for you. Just say daily, okay? And then also just say daily, okay? If you want to make it a certain color as well, if that's something that you understand, then obviously that's something you need to do. Okay, now we can jump down to the 6H. Okay, because we know we are in a selling trend for multiple reasons. We've broken that trend line to the downside. We have closed below that high low point, so we know we're on a selling trend. So now we are obviously looking at some sort of a minor level to take the continuation from. Start at the top, move down, perfect. Now we have those selling levels there, we have those selling levels there, we have that selling levels there, and now obviously we have the selling level over there. Once again, look at that big candle, okay? The one candle that messed up, look at that big spike and a pullback, okay? So once again, everyone is looking at an 800-point spike, which will most probably end up being a CPI, a NFP, something in that direction. But we are looking at the consistency in the chart, and that obviously gives us our support and resistance, okay? So now we have the minor level, okay? And if price sells from there, obviously, we know we're going to be looking to moving to the next level of support, okay? Because market moves from support to resistance and from resistance to support. So that is what we are looking at. But then trade management comes in. We need to always educate ourselves to look both ways, okay? So if we move this to the top side, we can see price sells from there, but we do have a minor. So let's just mark this off as 6H. And let's just mark this off as a minor. Okay. So what this means is, yes, we're taking the short position there at the top. But if we do not break through that minor level, then doesn't mean we're buying, but we'll most probably have a pullback and then another sell to the downside. As I said before, price repeats itself, okay? And that is what always happens. So here we had a push to the top side and then a sell-off all the way to the downside. But then the market came, broke above, and then came back to the buying level, bought up to the buying level, and then bought to the top side again. So very important to distinguish and understand the key between minor and key buying and selling levels. So support resistance for me is also another form of buying and selling levels, okay? Where does price buy from? Where does price sell from? If you look at all these levels where price is buying from, just mark it off, okay? And then where does price sell from? Mark it off, okay? And then through that, you're going to start identifying key turning points within the market. You guys see how I'm skipping those levels? Why? Because there's more turning points over there, so that will be more of a minor level within the market, but that will also more line up with a trend line. Okay. Okay, so secondly is supply and demand. Okay, so support resistance is mostly what a hedge fund uses to obviously trade from. So they have one key level and they enter. So what a hedge fund will usually do is if they see this is a selling trend, okay, they will sell on that key level. If it pushes higher, they will sell on that key level. And then if it pushes higher, they will sell on that key resistance level. So they will basically have a setup that will look something like this. And as soon as it pushes higher, they will sell again. And if it breaks through that level, then obviously they will call it, wait for pullback, and then they will start buying it again. So they use key support resistance levels to obviously take buys and sells on that levels. Okay, now the second thing there is called supply and demand. Okay, so once again, everything is just wording. There's so many different words for things. There's so many different ways you can explain it. For me, it's supply, demand, supply, selling zone, demand, buying zone. Supply and demand is obviously based on how banks trade. So just like we will have hedge funds selling on that key level, okay, we will always see a little bit of a spike higher or lower. Okay, if we look at this bottom, we can see, okay, well, there is a buying level, there's a buying level. But if we look to the left-hand side, there's quite a big move lower and then the buy. Okay, so where price buys and sells from is support resistance. But who covers the spikes? That's where the banks comes in. Okay, market would usually come down, and it will happen all over the place. We can see there price sells from, but what happens? We can pretty much probably duplicate the zone over to there. It will be the same thing. Okay, same thing. Okay, so what is the zones used for? Just clean it off. So what the zones are used for is how banks will trade. Okay, the zones are whether or not it's a breakout or not. Okay, so if the market gets to the support level, okay, who's buying from that level? The hedge funds. Okay, but the banks are also buying from key levels, but they obviously have more capital. So for example, what they will do is they will allocate, let's say, $1 million just towards this USD buy. Obviously, AI is doing it for them, key levels, okay? So rather than them having the big space of hedge fund or the small space, they actually have a pretty decent stop loss, let's say about 400 points, 40 pips, okay? What they will then do, or what the AI will do for them, is stack orders between their stop loss and their buying level. When I'm talking about orders, like hundreds of orders, like if it's 400 point stop loss, like every 10 points, there will be a buy order. What that then does is the more it pushes down, the more it buys and buys and buys and buys. 100 buying orders equaling to 100% risk, 1% risk, 1% risk. So the lower it goes, the more it opens up to risk to reward. So we'll see that final one will be 1 to 7C. Okay, so they're risking 100% of the $1 million. Sometimes if all the orders don't activate, 50% of the $1 million. But it will actually end up making them like 300-400%, obviously on that trade. So that is the key of supply and demand. If we look at this current level we're at, okay, we'll obviously see what their price sells from, perfect. So now forget about the one spike. We'll have our supply area over there. And we're going to see a little bit of a spike there as well. And then if price sells from there, it moves to that level. Okay. Their price buys from, and then we're going to see there is our spikes. So how will it work now? Okay. Supply demand is our indication whether or not price is selling or buying. So if we close below that zone, that means we have a breakout. Okay. When we have a breakout, retail will most probably do that. Okay, but that's not what we do. You have selling levels, you have buying levels. If we break through, we look to the left-hand side, we look at the selling level, we move our zone to the top, and then from there only, we're looking for the continuation. And once we're going to take the continuation, we're obviously going to be selling into that bigger buying zone over there. Okay, let's use another example. Okay, Here we have JPY. We can see price mostly, price from there. So here we're going to see a very small zone. Okay. Then same thing there, price will obviously form that level, but there will be a small area of demand. So not a lot of spikes. Okay. Then finally, we can see price south from there, and then we have the spike to the left-hand side. So obviously we'll have that zone over there. Okay. So now we're obviously going to be moving that zone to the bottom. Let's look at something like GBUSD. Okay, very good example. At the moment, we obviously can see we're in a buying trend. So we can see from there, price buys. Okay, but where is the spike? The spike is there. And as long as we are staying above that spike, we are buying. Okay, so what a bank will do, or what I will also be doing, is once price reaches that level, I'll be taking a buy position on that level, stop loss below that spike. The end of that spike is seen as a liquidity point, because that's where a bank gets liquidated or not. And then I will have I won't have 100, but I'll have like 2 or 3 orders, with the lowest order being on the zone, and also increasing my risk to reward. Okay. So now we can also see we're in a buy. So we also use supply and demand zones of a trade management tool. So now we can see price starts from there, price starts from there. Where's the spike? The spike is there. So now we're pushing into the zone. So now we know that if price now goes and closes with a full candle on the 1H above the zone, we're going to be buying. Okay. Where is the buying pressure? Look to the left-hand side, there's buying pressure there. So then we're going to be looking at moving back into that zone and then continuing to the top. If we do not break through that zone, so if we just close below now, that means we're most probably going to have a pullback first, and then obviously a buy to the top side. Once again, just as we have key support and resistance areas, we also have key supply and demand areas. And the same thing applies. The higher the time frame, the stronger the area of supply and demand. Okay, then finally, my favorite technical tool, Fibonacci. So Fib is something that I've learned a long time back. It's something that I learned myself. So I think that's why it's so important. Once again, support resistance I learned from videos, courses, etc. Supply demand was a little bit of both. So I found the concept from someone, and then I obviously changed it to understand it and obviously make my own. But with Fib, I've never seen a course actually present Fib. So since the beginning of time, I've always had to learn it myself. And I think that's why I love it so much and why I appreciate it so much, is because of the fact that everything that I know regarding Fib is what I figured it out. So the one thing we know is once price is in a buying trend, for example, once it has a push and a pullback, a push and a pullback, okay? We obviously want to enter on these points over there. This is where we make money as trend traders, as retail traders, etc. But this point needs to be an area of confluence. What is the area of confluence? The area of confluence is where everything comes together. Okay, so that's what I'm going to explain afterwards, is confluence, but Fib is my main tool towards getting the actual confluence. Okay, so the first thing you need to understand about Fib is you need to know the trend. Okay, here we had what people that trade smart money concept will call a BOS. I just call it the break of structure. Once again, it's just a word, guys. Never ever confuse yourself with words in trading. Okay, so once we have a break of structure on the trend, what do? That's when Fib comes into play. But we need to have a pullback first before looking to add our Fib. Okay, How FIB then works is always use your previous low to high. Buying trend, low to high. Selling trend, high to low. So if we know we're in a buying trend, we need to have our FIB from low to high. So what is low to high? Is it that one? Is it that one? Is it that one? Is it that one? So many different ones. Okay. So I always use pretty much anything. FIB is about confidence. What level lines up? Okay. So if we use this level, okay, we always look at 38% FIB. Okay. Or in the range of 61 to 78 FIB. Looking at the 38% FIB, I don't see any buying pressure to the left-hand side. Okay. Looking there, all of a sudden, there is buying pressure. Okay. So let's add our FIB back in. Okay. Now we have that 61. See how I'm using my FIB now to add the confluence and the demand zone. Okay. Or what you can also do if you're struggling with FIB, you can do FIB on FIB. Place a FIB there, place a FIB there. There we see there's a 61 FIB, there's a 78 FIB. So let's add the area of confluence where the buying level is at. And then all we have to do is just wait for a push into that level and then a rejection and then a buy. Okay. So now, for example, we're not going to add FIB because we're already in the buy. Okay. But FIB can also give us indication of market reversal. So if we're already in a trade, what we can do now is add our FIB from low to high, looking at the 38% FIB, some buying levels, but more towards the 61. Okay, so now we can say, well, there's a 61, add our zone to the 71. And we now know that if price doesn't break through that level, then obviously we are not going to break through. And that won't tell us to sell, but that will tell us to exit our buying positions. Okay, let's just look at another example. Okay, here's another example. Use the CAD. So we obviously had a break of structure there. Once we pulled back, okay, we need to pull back at all times. Once we pull back, we add our FIB from low to high. Okay, looking at this, to the left-hand side, there's buying pressure there, and there's a 38% FIB. But looking lower, where's the buying levels at? Over there. So it's also going to be at the 61. So we now know that we are going to pull back to either that level or to that level. Okay, the only thing that confirmed that entry is obviously candlestick patterns. Okay, we're rejecting multiple times, and then we're buying. Okay, so that's the concept of FIB. Okay, let's look if we can find a selling trend. And actually know if there's a selling trend at the moment in the market. Let's just move that over. Okay, so I'm actually going to show you guys on USD. We actually took a position on USD. So what we saw was break of structure to the downside. We added our FIB from previous. All right, so now let me use that level. Once again, you can do that as well. And then we look to the left-hand side. We identify what? Selling levels. Okay. Then we're going to see there's the 71, 61 lining up with that selling levels. And at the 38% FIB, there was no selling levels. Okay, let's quickly add our FIB in again. Much low. So we do have some selling pressure there at the 78 as well. So just like that, you already knew once you have the pullback, you are going to pull back to either that level and sell, or to that level and sell. The only thing that can tell which level it will be is your candlestick patterns. Okay. So that's the concept of FIB. If you're starting from the 61, you can use your 71 for the zone. If you're starting from your 71, you can use the 78 as a zone. And that's basically how it moves forward. Okay, everyone. So entry criteria. I've said this multiple times that Entry criteria comes down to two things, okay? Confluence and candlestick patterns. Okay, let's look at some good trades we had for the week. Let me just clean this off. Okay, let's look at the GBP USD trade. Okay, the only way to understand and educate yourself on entries, once again, is by number one, entering, taking trades physically, and number two is backtesting. Look at every single buying point, selling point, mark them off and try and understand how they actually work. So if we look at GBP/USD, okay, we had multiple confluences. We had the 61 fib, we had the buying level, we had the psychological level of 1245 round number, we had the demand zone, we had most probably a little bit of a trend line, which is not something I like using, so that's why I'm not explaining it in this video. But there's so many different confluences. If you guys want to understand trend lines better, here is a video of trend lines that I actually show you guys how to use trend lines. It is another form that you can implement into this, and it will give you a good explanation of how to actually use trend lines into the strategy. So we had so many confluences. So the only thing we needed was candlestick confirmation. Market comes lower. Look at hard retail, FOMOs. FOMO, fear of missing out. You buy before price even hits the level, go straight into profits, straight into drawdown. Once we actually hit the level, we pull back pinball. Then in the middle of the chaos, we have what's called a hanging man candle. Okay. Then big bullish engulfing candle coming through. And once we close above the zone, okay, so we don't trade in the zone. Once we trade above the zone, then we take the buy position, stop loss below the zone, and then have like 2 or 3 buy orders there. So if it does end up pushing lower, it will trigger buy order, and it will trigger buy order, increasing your risk to reward. Okay, GJ was no entry. GA is also a trade that I sent out. So pretty simple. We do have the 186 psychological level over there. We do have our fib low to high, so we can see there's the 61% fib. So once again, multiple confluences for this specific position. So let's quickly jump down to the 30-minute. Once price reached the zone, pin bar started. Okay, multiple spinning bottoms, pin bar, morning star formation. And once we close above, I'll take a buy and I'll take my continuation. Stop loss below the zone. What will I have? I will have 2 buy orders set in the middle of the zone. So market will push down, trigger that buy order, trigger that buy order, and we will actually have a perfect 1 to 7 running, perfect 1 to 5, 2 to 12, and a 1 to 3. So literally doing 3 to 15, risking 3%, 15% up on this account. And obviously we are looking for even higher levels to be achieved. So once again, once we have area of confluence, we need to be patient and wait for that specific level to be rejected in a form. And we don't trade within the zone. We wait for the rejection outside the zone. Okay. So if you, for example, have a problem with just entering as soon as the market hits a zone, then adapt to that. Okay, understand, okay, well, I have a problem with just entering, so let's adapt to that problem. The way I adapt to that problem is by writing down, I will wait for 2 1-hour candle closes. I will wait for daily close. So there's quite a lot of criteria that you can actually look at when looking at entering. But in the end, candlesticks is the only thing that can tell us if there's buyers or sellers in the market.
Once again, guys, thank you for watching and thank you for supporting. I hope you guys enjoyed this video. For most of you guys that made it to this point, you obviously want to be somewhere in your trading career. So a lot of people don't make it to this point of the video. The reason for that is it becomes boring and it becomes long. But in the end, that's what trading is. Trading is the biggest market in the world. Forex is the biggest market in the world. And it does take time. And if you're not willing to sit through 30, 40 minutes worth of content, then obviously you don't really want to be successful. When I started trading back in the day, I literally was spending so much time on the charts that I literally saw charts in my dreams. Even last night I had a dream where I made 1.2 million rand on the trader for no reason at all. It's because I have a passion for trading, I love trading, and I'm obsessed with obviously studying the charts. Thank you guys for supporting, and I will see you guys on the next one.